Hey guys, it is August the 4th and another crazy day in the markets today. Let me share my screen. Past performance is not indicative of future returns. As you can see, the indices are down a bit and crude oil has actually made it below 90. And I'm going to talk about why that is, and then some of the earnings reports that came out that I think we're getting a massive opportunity. And I think by next week, it'll be very clear that there's something up with this IEA report because we're going to have heat waves in like most of the country. And either the companies are lying or this is just a data blip because it just doesn't make any sense. Let me share with you what I'm seeing in just a second, but let's look at FinViz. You can see, I would say that this looks a lot like portfolio repositioning. This, I'm going to go through why energy is weak and why it's a buying opportunity. Amazon up 2.4%. There's this desire to buy it. It's almost to the place where I would be getting quite concerned that it's probably a better short than a long. For the third quarter, because I'm just not convinced this third quarter is going to be what everybody thinks it's going to be. We still have no economic data this week. Next week is a different story. And then we had a ton of earnings reports this morning, not the least of which was Consol and Albemarle, two that I'd been playing pretty aggressively. And then we had a bunch of earnings reports yesterday as well. So we're in the digestion phase. And so that's what is reflected by this kind of mixed bag of earnings mixed bag of performance that we've got, where you've got some companies that are in the same sector and do identical businesses up and down at the same time. I would say that certain parts of the economy are doing particularly well, but I do want to just go through, these are my new thematics as far as they go. And this is, I definitely am taking a contrarian view right now. And it is these three things where the market feels one way and I don't agree. And I may end up being wrong, but I'm just going to say it. I'm going to throw it out there. I'm going to be brave. The first thing is that a supply-driven global economic recession is not the same as a bank-driven, liquidity-driven economic recession. And what I mean by that is that right now, there's this belief that the commodity prices should be lower because GDP is going to be lower. I think it's actually the reverse. I think it's because commodity prices are so high, it's the thing that's holding back an otherwise just fine GDP or just fine demand picture. A case in point, I was having a conversation yesterday that I'm going to clarify this a little bit. The only reason that we're doing what we're doing on the rate side is to try to get the one area that the Fed actually really can control. So they can't control labor. That's Congress. They're going to have to let more immigrants in or do any number of things. They can't control companies because they don't have any kind of taxation rights or anything like that. That's Congress as well. And then to a lesser extent, you might be able to say the Treasury, but it's really Congress. But they can raise rates to make it difficult for more building to happen, which is a huge portion of the economy. If the economy was actually something else, you wouldn't need to raise rates, but they actually absolutely need to slow down some of the builds that are happening due to the housing shortages that we're seeing, due to the auto shortage that we're seeing, or the auto replacement all-time record old car situation, for lack of a better way, that we've been talking about. And so this is a real issue, and it is showing clear as day in the earnings that I'm going to go through today. Albemarle, Consol, which I've been talking about, and a couple of others. Let me look real quick. I'll also be discussing Sensionics and booking, what I'm seeing there. So I really want to just highlight that I will probably sound different from others for a while, and either I'm wrong or other people or something in the middle is the case or something. But I feel pretty confident from what I'm hearing on this earnings report that I'm not insane to think the way that I think. The other thing is that we have not had this type of situation in America, even in the 70s, because in the 70s, just remember, in that 73, 74 timeframe with OPEC, Fannie and Freddie had, Fannie Mae had just gone private and Freddie was like a baby as far as securitization of debt and what that meant. So this was it's very hard to compare to the 1970s, what's going on today. And the only other place that I think should be investigated as to how to think about it is Asia, because Asia has had times when the thing that's been holding back economic growth is raw material richness. Now, I think it's not perfectly comparable, so I have to, after earnings season, do some work on this. But the U.S. is just so rich as relates to raw materials, as relates to food, okay? Now, Mosaic and CF, I have a very strong positive opinion on it. And I did say, and I actually think it's not the craziest thing to say, given where their book values are, if you're a nation that doesn't have fertilizer, it may actually be very relevant for you to start just trying to take a slug of these companies down, because, you know, these resources aren't everywhere and they're not infinite. And we are going to have a multi-quarter, multi-year grain shortage. So the other day, check out my videos that are posted. I did talk about how you can use the options market to get a better pricing on wheat than what we're seeing because of the nature of what's going on in the options market right now. So I still feel strongly about that, but I want to show you, this is what actually took energy down. It was this, the EIA commission does release weekly fuel data. That's really what it is. You know, and you saw this inventory build from Nat, very small inventory build in Nat gas, and then 4.5 million barrels versus what was expected to be a down 500,000 barrels on crude oil. But that's kind of an offset from the previous week. So I think most people are still like, I need another week to make sure that I feel comfortable about that. Additionally, we're going into a massive heat wave. And so either we are somehow magically building oil, or every company that just reported earnings is right. So now the massive disconnect between what we saw this week from the EIA and what literally every company is telling you. So let me show you a couple of things that you just want to be aware of. This is, I love this map from the EIA. I wanted to pull it in here just so you can get a sense for what is U.S. import-export situation. We are a net exporter, but not every region is. The Gulf Coast is 100% net exporter. And then depending on what part of the nation you live in, this is what it looks like as a picture. But what I really want to make sure that you guys appreciate is that it is still the case that we are supplementing oil by drawing down our own reserves. So even with this inventory build, it's not going to compensate for what we've already drawn down as a function of this crisis. But this to me was Consol Energy, which you know I've been really bullish on. This earnings report proves that what I've been saying is correct, which is because they have certain facilities that are on the East Coast and they've worked so hard to try to build up their capability to export, they are benefiting. And this is what we saw. We saw more than a doubling of gross margin, gross income. You can see that operating earnings is almost a 400% improvement. And then I want to show you, and then obviously that rolls all the way down to net earnings. They are paying down debt for whatever reason. I think there's a shortage of people, quite frankly. Here, let me just lower the size of this so you can see this better. But this is what they reported and what they got in pricing. And they actually have finally, what they've finally done is they've basically paid down enough debt to make it to where they're starting to give away dividends. Now, I personally, so they did issue a special dividend of $1, and then in the future they're going to do a combination of dividends and share buybacks as they finish off paying off debt. Because remember, this industry was taken to the brink of bankruptcy in 2019, and even before that, because of what we've been doing on the energy front to shift from coal to nat gas, certain things have happened. Now, I want to show you this because this is the price, the realized price per ton that they got, $72. Their guidance was for $64, so they're way over it. And someone asked the question like, hey, two very important questions. Like, what did you sell the marginal amount of coal for? So remember, utilities companies in the US are still buyers of coal, and they started buying coal, which is when I was like, I can't do this anymore. I've just got to go long coal. But they started in November and I already knew that. And then by March, when war was declared on the continent in Europe, you know, I was like, okay, even though there are no coal companies in the S&P 500, I got to do some work here and just find the best way to play it. And Consol was at 33 or something like that, maybe 36 by the time we really started getting super aggressive on our verbiage on it. Now it's in the 60s and it's not coming down. And it really has to do with this. there was they in the last quarter they talked about the incremental buyer and how if anybody had any extra coal, it was going to get sold for a much higher price. Even then we were talking like 64, 67 was the range. They've been selling incremental coal at $100 a ton. Okay, so this is like way over even what they got this last quarter. And then this analyst asked the brilliant question, like, what percentage of that is going overseas versus domestic? And he's like, look, I've told you for many quarters, we are really ramping up the international business because we know that's the future of our company, but about 70% of it was sold domestically because we still are always going to support the US economy and the US utilities companies that have been our customers for decades. So that actually got sold in the US. And that has to do with why I put up this map here, because the East Coast is actually worried, especially the mid-Atlantic up here, where you do get temperatures that are crazy. We're going to have a heat wave this weekend. And with it's utilities companies saying, uh-oh, we might actually just need to have a little bit of coal just there as a possibility, because this Europe thing, it doesn't look like it's going to resolve quickly. And even if it does resolve, there's some issues, which I'm going to show you again, one other item in Europe that you should be aware of. But they just want to shore it up for the winter. Even we want to shore it up. And that has to do with this rising crazy LNG price, because Europe is 100% willing to pay for it. Now, I want to show you two things that came out that are still extremely relevant to why I continue to be very bullish Consol. There's going to be some things that have to be fixed as relates to infrastructure in the Powder River Basin, which is where Arch and BTU have the bulk of their thermal coal projects. They've got some met coal projects in other locations, but I want to show you this. This came from Air Products, and Air Products does produce some chemicals that are used for energy, namely ammonia, hydrogen. And so one of the things, they actually negotiated their contracts. I was long this. I will take a little victory lap on it, but I went ahead and sold my position because I just want to have a little more cash as things settle post earnings season. But this is what they showed within their deck, because they are 100% passing through shipping, freight, all that other cost to Europe. But this is actually what Europeans are experiencing. I know most of the folks here are American or from some other nation, Canadian, et cetera. They have a 3 to 4 time increase in power costs. This is why I have been saying there is a scenario where the US is absolutely the net beneficiary, because we are not experiencing this. We are definitely experiencing an increase in our power costs, but not nearly like Europe is. And also remember, we can still go to coal because we produce coal. Now, is there coal on the continent of Europe? Yes, there is, but realize that war creates all kinds of infrastructure issues, but even more than that, because, you know, one of the bigger areas that you would have gotten coal was obviously Russia, Ukraine, Belarus, et cetera. But this is also an issue, which I didn't even know about this week, the Rhine River, which is where some of that coal comes out of. So this is a big coal deposit for Germany, Cologne. And it's called the Rhineland region for a reason. So for those of us, self-included, very much so an American trying desperately to get better at geography, but just so to help my fellow Americans who are terrible at geography like I am out, this water level has been really low, and it's creating an issue for these coal-fired plants, further frustrating the energy crisis within Germany. So this is bad, number one. And number two, it bodes really well for us, the United States, as a natural resource giant, for lack of a better way to describe it, because that's what we're really emerging as. It also suggests that this nonsense that we're experiencing within the oil pricing, and it just doesn't make any sense. It really doesn't make any sense. The US producers are not seeing a problem in increasing the volumes. I took a quick glance at Apache. I'll have more on that. But Apache does do quite a bit more in Africa and Europe, and their volume numbers, even though their earnings finally looked good for once with Apache, their volume production wasn't a clean number. So I will come back to you tomorrow with more details on that. So that is the picture that I'm seeing Interestingly enough, on the technical side, subscribers of Guerrilla through of Markets with May through Guerrilla do get access to the Guerrilla algorithm. Even on a technical side, DVN Energy, which continues to be one of my favorites, did actually hit a signal. So, I mean, at an 11% plus dividend yield, and the fact that most of that dividend is variable. So if they get really frustrated with the price of their stock, they can literally buy it back. They still have $1 billion of buyback, and there's literally not a better use of cash right now. These companies are minting money because the fact is, if they sell it cheaper, it's not like it does all of us a favor. It's just going, like, if we sold it to the US for cheaper, all that's going to happen is that another country that desperately needs it is going to be willing to pay more. And that pull is just going to keep going like this until it will make no sense. In the meantime, all of the energy complex is just going to pay down its debt and lower its cost of capital. And I want to reiterate how crazy it is. Consol has already lowered its debt levels to, I think it's like by the end of next quarter, it'll easily be under its projected, desired leverage ratio, under 1x EBITDA, which means that they could, off all our debt in a very short order. And it's just a function of the rating agencies actually taking the time to review the documents and realizing that none of these guys really have that much debt. So that's the picture that I'm seeing, and it is what it is, but the stocks are reacting the opposite. To me, that screams opportunity. If you are an investor and have a little bit more horizon, it also means that it's going to be really fun to day trade these, because my goodness, are they swinging around? Shout out to Richard, who's also part of the Guerrilla family and has a wonderful show first thing in the morning. Now, I do want to also mention Albemarle, which I have been very bullish on and is trading ridiculously this morning downwards. It makes no sense. This was the most amazing earnings that I've seen of a company. I mean, like, if you think the energy companies are doing well, Albemarle was crazy. Like, top line growth. This is just to then lithium. So they're the biggest lithium producer, and then bromine. And then they do catalysts, but the bulk of their business is this. This is the net sales. It's almost 200% increase in sales just off the lithium. And then all of it's being brought down to the bottom line. So EBITDA increase of over, almost 350%. And that is because global demand is actually that high. So why do we care about lithium when we're studying energy or trying to get up to speed on energy? We care about lithium because lithium goes into batteries, and it goes into electric vehicles. I don't know what's wrong with me today. Sorry, sometimes I trip on my words, but the point is, and then bromine, what is bromine used for? It's used to put out fires. So all of this like drought that we're experiencing, all these forest fires, everything, that's a bromine use case among many other use cases. And then catalysts, most of their catalytic stuff is used in the production of energy. So oil, nat gas, et cetera. So this business is doing crazy good. And I had mentioned last quarter that the reason I wasn't already bullish Albemarle in the past was because they had had fixed price contracts that were multi-year or a couple years. They moved to spot contracts and are sticking there because the market is that crazy. I think the market occasionally sells Albemarle because a lot of its projects are in Asia. I think that's stupid, to be fair, because you have a lot of population, and Asia would be the place that would feed Europe on its massive needs and demand right now for electronic storage improvement, for lack of a better way to say it, across either internet, IoT stuff, or just even flat out to create batteries to improve the efficiency of utilities companies. So anyways, the point is Albemarle, it is a definite opportunity. If you own it, I would not sell it. I would not be confused that they had a bad quarter. They did not have a bad quarter. If anything, they had an astronomically amazing quarter. And then I would also mention on booking, I have tonight, Expedia will report earnings. Booking is trading kind of sideways to slightly down. There's no reason for that. This was a doubling of revenue. This all went to the bottom line. They are now operating income positive, which was not the case last year and has not been the case for several quarters. But between Booking and Expedia, Expedia will report something very similar as far as a very strong quarter, in my opinion. We shall see tonight. But Expedia was more of a turnaround story as they started to, transition their technology. So Expedia had done a ton of acquisitions and they brought in a new CEO to just stop competing against themselves, quite frankly. And he got the bulk of it done last quarter. We started to see all of his hard work finally work. I think this quarter we're going to see the benefit of it. Especially when we comp it to last year's numbers where he was still working through some of that. So I'm still very bullish Expedia. And we are absolutely yet, and Air Products just spoke to this, we're not yet seeing an true economic slowdown relative to what we would have expected with all of this energy craziness and inflation craziness that's happening. Last couple of points that I'm going to mention. Just to close out energy. And then I do want to address Sensionics, which I have been very bullish on and has run up a bit. I am taking some profits there, but I'll show you why. Dividend royalty right now are really these two companies. That is DVN Energy, which will have no problem paying you your dividend for a while. It's yielding, depending on where it's trading at any given second, well over 10%. And there's no risk to that. The only risk you have is they don't pay you a dividend. Instead, they just buy back stocks, which naturally takes the price of your capital increase upwards. But I think they continue to do a combination of both. So right here, you should, if you have money that you just don't want to touch and you want it to be there, DVN will be fine for more than a couple of years. And then the other one is actually Icon, which we'll report on Friday. He is still yielding about 15%. Most of that cash flow is like, you're not going to get a lot of risk. And plus he does have within this company, the refining business, which is going to continue to just print money for the foreseeable period. And then other than that, he's got a couple of other businesses that are fantastic and should be fine. Literally it's the sausage making stuff. So it's sausage casing. And then you've got some healthcare stuff in there as well. So those two, I continue to think will be just fine to yield you a nice, happy dividend. If you're a more calm, like I just want to be a long-term investor, I don't want to be thinking too hard about it. Those two. The final thing I just want to say, Sensionics was the lottery ticket dollar stock. Remember, it was about $1. I think I continued to talk about it at $1.20. I have it both in the format of stock, which I will not sell right this minute, and options. I lightened up on some of the strikes because I had both $2 and $1 strikes farther out in January. So I lightened up on the $2 strikes as it is cresting $2. This is what's happened and why it's done that. It has to do with the fact that a couple of really large insurers are picking them up and okay with the payback on the Sensionics device, which goes under arm and it addresses the diabetic need to just know what's going on with blood sugar levels, et cetera. Okay. There is a lot of conjecture, and the reason this becomes a meme stock from time to time is because everybody loves the sensing business in general within healthcare, because there are a couple of big tech companies that have been very clear that they would gladly and happily take on that kind of business. Now, do I think that it's a little bit aggressive, this run up? I actually do think it's a little bit aggressive, but not enough to punt out everything. I still want, if you're doing Sensionics, for you to be a little bit farther back. And especially now that it's almost doubled from where I was recommending it, just be careful. Earnings is next week. I need to hear them say some things on it. Otherwise, I think that the time period is a little bit too fast for how aggressive this thing is run up. And I really want to talk about why. Right now, they're still in that early phase of getting product to the market. So a lot of their money is going to sales and marketing, as you can see here. This was last quarter, and research and development. Why R&D? because they are trying to make the sensors last longer. So before in the March period, they had a 3-month sensor that was just shifting to a 6-month sensor that is apparently working really great from the checks that I've done. And now they're prepping and trying to launch a 1-year sensor into the arm. And so that's really what the R&D is all about right this minute. There are people that have other dreams for what that R&D could be once you install a sensor into someone's body. So that is what it is. But additionally, they still have some R&D cost associated with demonstrating clearly that this is safe for children, which will be a big market. So we're still a little bit early because we're still going to see some pretty aggressive expenses. And also, I don't know if we'll see the revenue ramp up as fast as I personally would like to see it, as fast as the demand in the marketplace actually is for this company. And that is because I have yet to see them do what I would call an exciting job on supply chain management. Now, this quarter, we do have some improvement on the semiconductor space, which we're hearing from literally every semi company that has reported earnings. So it is possible that we do see a better job on supply chain management. That's what I'm hoping to hear. So I am a little bit scared to be too aggressive going into the quarter. That said, if you bought it when we started being extremely bullish on it at $1.20, you know, if you want to lighten up, that's fine, but I would just chill out and know that the reason we were excited about it was for multiple years, not for earnings coming up here and the craziness that might ensue. I'll be watching it because we'll see how it transpires. Yeah, and then ultimately, my vision of what happens to Sensionics is either they fix all of these supply chain things and we start to see financial statements that make sense, or alternatively, someone just uses their COVID money, for lack of a better way to describe it, and I've been saying this, and just buys them out because this is a good product. Like, people like it, people want it. Their issue is not demand, it's supply right now. And with that, I will go ahead and hit the pause button and take some questions. That was a lot today. Hopefully it was helpful, because I know you've got some of these positions for sure this time, Dave.
Hi, May. Okay, Sensionics, I think their competition is you exchange the monitor every 2 weeks.
Yeah, well, they've got a couple. Abbott is they're different. So Dexcom is oftentimes used, and that's external. That's on the outside of the arm. And then the other one would be Abbott. Those are the 3 big players within this type of product, for lack of a better way to describe it. And each of them has their own deal. Sensionic goes into the body, though, which is particularly good for kids because they're running around like crazy, and the sensor could just fall out if it was external.
Right. But what I was reading was Sensionics, you exchange it every 6 months.
Currently, yes.
Versus the current the competition is every 2 weeks.
Okay, I'm not sure which company is being referred to there, but I would say that the biggest competition within diabetes sensing is still Dexcom and Abbott's product, those 2 products.
Yeah, but I think that you exchange those every 2 weeks.
No. They're just totally different. It's just a totally different mechanism.
Okay, cool.
Yeah.
Okay.
There may be some other competitor, or the 2 companies may have one product that's internal, but the major products within diabetes sensing are, largely speaking, it's a choice for a doctor to make with external versus internal implantation. And external still makes sense for a lot of folks, and insurance covers Dexcom's product.
Right. Well, the point I was making is it's a lot easier to do it every 6 months versus every 2 weeks.
Sorry. You're right. Yes, that is true. That's absolutely true. Yeah. But you wouldn't implant something and then re-implant it every 2 weeks. That's why I'm not sure what specifically they're referring to as relates to 2 weeks. That sounds more to me like some of the external products.
Right.
Yeah.
But I think I would rather want an internal every 6 months and exchange an external every 2 weeks.
100%. Yeah, no, people really do love this product. You know, when I was doing random checks, you know, just asking diabetes people online, like doctors and patients are happy to talk about it. But the major thing that is frustrating for them is because unlike the, this is why I say it's slightly uncomparable to the stuff that's external. is because you need right now still a doctor to implant underarm because it's still an implant. They're trying to get physician assistants to do it and approved for it and trained for it. That actually will help them out a lot. Additionally, they've had some shipping issues that are really unfortunate. And then we have record high temperatures. So, in certain, the sensor requires certain temperature controls. And I'm not sure if that's gotten fixed, but more than one person that I talked to said that when their sensor arrived after a 6-month waiting period, it arrived damaged because the temperatures had gotten so high this summer, so to speak. And they just didn't even, and that was before we've been hitting 104 degrees at night in Austin, Texas. So their location though is on the West Coast. We're having a heat wave now on the East Coast. Sorry, their location's on the East Coast. I think they're in the DMV area. But anyways, my point is that I need them to fix their supply chain because most of the criticism was that people were waiting forever to get this sensor, not that they didn't want it desperately. And a lot of doctors had mentioned that the final products that they really like giving to their customers is this product from Sensionics and Dexcom's product.
Okay. Cool.
Sorry, that was a lot. That was a mouthful. You asked a very simple question. We're trying to make a point, but I'm really passionate.
That's a huge growth area.
It is a huge growth area. Yeah, that's why no matter what happens to earnings, I'm going to be watching it. Last time it ran up to $3 and then cratered. I didn't love that. But in fairness, at $3, doing the work on it was worthwhile to me because I understand that it's probably a little bit overvalued if it runs up too aggressively, in which case I'm just going to figure out like how I want to hedge myself or post earnings, not pre-earnings, that sort of thing. Because, but I do think that we'll have to see what happens on earnings, how much they fixed, how far they got, but I'm in it for much longer than what the meme guys might be in it for. I think this one's a buy and hold for a while. Ultimately, they will either be the same market cap as Dexcom or they will get bought. Only one of two things can happen.
Yeah, you can buy the 2023, January 20th, 100 call, right? No.
$1, yeah.
$2 call.
Yeah, I mean, I would just be a little sensitive in front of earnings. If you were going to do like 100 options on it or something, do like less than that and then take the rest in after you see what happens on earnings. Because I think that there is a possibility that the people that are buying it now are not buying it for the right reasons. Like this could just be a run up into earnings, but nonetheless,
those options are really, really cheap. 42 cents.
That's true. At 42 cents, you may just be like, whatever. I mean, for me, my ownership of all the options was like 17 cents or something. Cause like literally, if you go back and look at my old videos, which I haven't posted yet, so I will post them. But we talked about this when the stock was $1 and then at $1.20. I think we were like, listen, right here, it's going to bounce around. But, I think I even bought more last week at $1.28 or something because I was just like, I kind of want more of this. Yeah. But I'm in it to like literally own it until it like for a while.
Yeah. That's a great growth company. Okay.
Yeah. Cool. All right. Any other questions?
None for me.
All right, cool. Everybody, good luck out there. Bye.